Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders think their edge lies in identifying good trades. Professionals understand that edge is equally defined by the trades they do not take. Trade selection is not about activity, it is about filtration. It is about discipline. In a world that constantly tempts you to engage, every time you place a trade, you are allocating finite capital into one idea while simultaneously rejecting all other possibilities. That decision carries an implicit cost. This is what is known as opportunity cost, and it is one of the most underappreciated forces shaping long-term trading performance. Capital is not infinite. Attention is not infinite. Emotional bandwidth is not infinite. When you commit to a trade, you are locking these resources into a single outcome path. That path may or may not be optimal. The question is not whether a trade is good in isolation. The question is whether it is the best use of capital relative to alternatives. This is where retail thinking diverges sharply from professional thinking. Retail traders evaluate trades in absolute terms. They ask, is this a good setup? Professionals evaluate trades in relative terms. They ask, is this the best opportunity available right now given all competing options? That shift changes everything, because now you are not simply trading setups. You are constructing a portfolio of decisions. Each decision must justify its existence not only against risk but against every other opportunity in the market. This forces selectivity, it forces patience, it forces prioritization, and most importantly, it forces you to accept that doing nothing is often the highest quality decision available. Opportunity cost is invisible, which is why it is so dangerous. Losses are visible, drawdowns are measurable, but the cost of allocating capital to a mediocre trade instead of a high quality one does not appear on your statement, yet it quietly erodes performance over time. Imagine two scenarios. In the first, you take 5 average trades. Some win, some lose, and overall you break even. In the second, you take one high conviction trade and allocate properly. That trade performs, and you generate a meaningful return. The difference is not skill in execution, it is discipline in selection. The first trader feels productive, the second trader appears inactive. Yet the second trader is operating at a much higher level of efficiency. Professional trading is not about maximizing the number of trades. It is about maximizing the quality of capital allocation. Every trade you take must clear a threshold. That threshold is not static, it is dynamic and context dependent. It depends on market conditions, volatility, macro backdrop, and the availability of better alternatives. This is why institutional traders often spend more time not trading than trading. They are constantly evaluating, filtering, comparing, and waiting. Waiting is not passive, it is active decision making. It is the discipline to reject trades that do not meet a defined standard, even when the market is moving and the temptation to participate is strong. To understand trade selection properly, you must think in terms of expected value across a portfolio of opportunities. A trade is not simply a setup, it is a probabilistic proposition with a distribution of outcomes. Some trades have higher probability but lower payoff. Others have lower probability but symmetric payoff. Your role is to allocate capital where the expected value is highest, not where the probability of winning feels most comfortable. This distinction is critical. Many traders gravitate towards trades that feel likely to work. They prioritize win rate over payoff. This often leads to consistent small gains, punctuated by occasional large losses. Professionals invert this thinking. They seek trades where the payoff justifies the risk, even if the probability of success is not overwhelmingly high. But here is the key point. Even within positive expected value trades, not all opportunities are equal. Some trades offer marginal edge, others offer significant edge. Some are highly correlated with existing positions, others provide diversification, some are sensitive to macro uncertainty, others are insulated. Trade selection is about ranking these opportunities and allocating capital accordingly. You are not asking, should I take this trade? You are asking, where does this trade sit within the hierarchy of available opportunities? Only when you adopt this mindset does capital allocation become efficient. Let's introduce a practical framework for trade selection. Every potential trade should be evaluated across 3 dimensions: quality, clarity, and alignment. Quality refers to the underlying edge. Does the trade have a strong fundamental or structural basis? Is there a clear reason why the market may move in your favor? Clarity refers to the execution environment. Is the setup well defined? Are the entry, stop, and target levels logical and clean? Or is the trade dependent on noise and ambiguity? Alignment refers to how the trade fits within the broader portfolio. Does it complement existing positions, or does it increase concentration risk? Most traders evaluate only quality. They see a good idea and act on it. Professionals evaluate all 3 dimensions simultaneously. A trade with strong quality but poor clarity may not be actionable. A trade with good clarity but no underlying edge is meaningless. A trade that conflicts with your existing portfolio may introduce unnecessary risk. Trade selection is therefore a filtering process. Only trades that score highly across all 3 dimensions should be considered for meaningful capital allocation. Everything else is either ignored or traded at reduced size. Now let's address a critical behavioral issue: the need to be involved. Many traders feel uncomfortable when they are not in the market. They equate inactivity with missed opportunity. This creates a bias towards overtrading. Overtrading is not simply taking too many trades. It is taking trades that do not meet your selection criteria. This is where opportunity cost becomes destructive, because every low-quality trade consumes capital, attention, and emotional energy that could have been preserved for higher quality opportunities. The market does not reward activity, it rewards precision. There are periods when the market offers abundant opportunities. There are periods when it offers very few. Your job is not to force trades during quiet periods. Your job is to recognize when conditions are favorable and scale accordingly. This requires emotional discipline. It requires the ability to sit through inactivity without feeling the need to act. Professional traders are comfortable with boredom. They understand that waiting is part of the process. If you feel the need to constantly trade, you are not operating from a position of control. You are reacting to psychological pressure. Capital allocation is the natural extension of trade selection. Once you have identified a set of potential trades, the next question is how much capital to allocate to each. This is where many traders make a critical mistake. They treat all trades equally. In reality, trades should not be treated equally. They should be weighted based on conviction, edge, and risk characteristics. A high-quality, high-conviction trade should receive more capital than a marginal setup. A trade with asymmetric payoff should be prioritized over one with limited upside. But this does not mean increasing risk recklessly. It means distributing risk intelligently. Capital allocation is not about how much you can make. It is about how much you are willing to risk relative to the quality of the opportunity. This requires a structured approach. You need a framework that allows you to scale position sizes based on predefined criteria. Without this, capital allocation becomes inconsistent. And inconsistency is one of the fastest ways to erode an edge. Let's go deeper into conviction. Conviction is not a feeling, it is not confidence, it is a function of evidence. A high conviction trade is one where multiple independent factors align in your favor. This could include macro drivers, positioning, technical structure, and market sentiment. The more independent variables that support a trade, the higher the conviction. However, conviction must be grounded in analysis, not emotion. Many traders mistake emotional attachment for conviction. They become fixated on an idea and increase position size without objective justification. This is dangerous. True conviction is measured by how robust the thesis is under different scenarios. If the market moves against you, does the thesis still hold? If new information emerges, does the trade remain valid? Conviction should increase when the quality of evidence increases, not when the desire to be right increases. This distinction is critical for disciplined capital allocation. Another key aspect of trade selection is correlation. Many traders unknowingly concentrate risk by taking multiple trades that are effectively the same position. For example, being long multiple currency pairs that all reflect the same underlying macro theme is not diversification, it is concentration. Trade selection must therefore consider not just individual trades, but how they interact. You need to understand where your exposures lie. Are you heavily biased towards a particular asset class, currency, or macro factor? Are your trades reinforcing each other or offsetting risk? Professional traders think in terms of portfolio exposure, not individual trades. This means sometimes rejecting a good trade because it increases correlation risk. It also means sometimes accepting a trade with slightly lower individual edge because it provides diversification benefits. This is a higher level of thinking. It moves you away from isolated decisions and towards integrated portfolio management. Timing also plays a role in trade selection, but not in the way most traders think. Timing is not about finding the perfect entry. It is about entering when the conditions that support your trade are most favorable. This includes liquidity, volatility, and market structure. A good trade taken in poor conditions can perform poorly. A marginal trade taken in ideal conditions can perform well. This does not mean you chase conditions. It means you incorporate them into your selection process. For example, entering during periods of extreme volatility may increase risk beyond acceptable levels. Entering during illiquid conditions may lead to poor execution. Trade selection must therefore include an assessment of the execution environment. This adds another layer of filtering. It ensures that you are not only selecting good ideas, but also executing them in conditions that maximize their probability of success. Ultimately, trade selection is about discipline at the highest level. It is the ability to say no more often than you say yes. It is the ability to prioritize quality over quantity. It is the ability to allocate capital where it has the highest expected return relative to risk. This requires structure. It requires a defined process. It requires consistency. Without a framework, trade selection becomes reactive. You chase moves, respond to noise, and gradually lose control of your capital allocation. With a framework, trade selection becomes deliberate. You operate with clarity. You know why you are taking a trade, how it fits within your portfolio, and how much capital it deserves. And perhaps most importantly, you know when not to trade. Because in professional trading, the difference between average performance and exceptional performance is not just what you do, it is what you choose not to do. Once you begin to treat trade selection as a structured process rather than an instinctive reaction, you start to see the market differently. You no longer scan charts looking for anything that resembles a setup. Instead, you begin with a defined set of criteria, and the market either meets those criteria or it does not. This creates a filtering mechanism that protects both capital and mental clarity. Think of your process as a funnel. At the top, there are countless potential trades. As you apply filters, macro alignment, structural clarity, risk reward, liquidity conditions, and portfolio fit, that universe narrows significantly. By the time a trade reaches the execution stage, it should be one of very few that genuinely justify capital deployment. Most traders operate without a funnel. They operate with impulse. They see movement, interpret it as opportunity, and act. This leads to inconsistent decision making and fragmented performance. A professional approach is the opposite. It is restrictive by design. The goal is not to find more trades. The goal is to eliminate inferior ones as efficiently as possible. And when you do this properly, you begin to notice something important. The frequency of your trades decreases, but the quality of your outcomes improves. This is the trade-off that defines professional trading. Let's formalize the concept of a trade selection threshold. A threshold is the minimum standard a trade must meet before capital is allocated. This standard should be explicit, not implied. It should be defined in advance, not adjusted in real time based on emotion. For example, you may require a trade to meet criteria across multiple dimensions: a clear macro driver, a defined technical structure, acceptable risk reward, alignment with broader portfolio exposure, favorable liquidity conditions. If a trade fails any of these, it does not qualify. The purpose of a threshold is to remove discretion at the point of decision, because discretion, when influenced by emotion, leads to inconsistency. Now, an important nuance: the threshold is not fixed across all environments. In periods of high opportunity, you may raise the threshold because there are more high-quality trades to choose from. In periods of low opportunity, you may lower it slightly, but never below a level that compromises your edge. This dynamic adjustment is what allows you to remain flexible without becoming reactive. The threshold defines your standard. Your discipline determines whether you adhere to it. Let's talk about the concept of trade density. Trade density refers to how many opportunities the market is presenting at any given time. It fluctuates constantly. There are periods where multiple high-quality setups appear simultaneously, often driven by strong macro themes or regime shifts. Then there are periods where the market is fragmented, directionless, and dominated by noise. Recognizing trade density is critical for effective capital allocation. In high-density environments, the challenge is prioritization. You may have multiple valid trades, but limited capital. This forces you to rank opportunities and allocate accordingly. In low-density environments, the challenge is restraint. There may be very few, if any, trades that meet your criteria. This is where most traders struggle because inactivity feels uncomfortable. But forcing trades in low-density environments is one of the fastest ways to degrade performance. Professional traders adapt to trade density. They scale activity up when conditions are favorable and scale down when they are not. This adaptability is what allows them to preserve capital during difficult periods and capitalize during optimal ones. Now consider the relationship between trade selection and drawdowns. Drawdowns are not random. They are often the result of deteriorating trade quality. When traders enter a drawdown, there is a natural tendency to increase activity. They try to recover losses by taking more trades. This is a mistake. What typically happens is that the selection threshold drops. Trades that would normally be rejected are now accepted. This leads to further losses, reinforcing the drawdown. The correct response is the opposite. When in drawdown, you should become more selective, not less. You should raise your threshold, reduce trade frequency, and focus only on the highest quality opportunities. This serves two purposes. First, it protects capital by limiting exposure to lower quality trades. Second, it restores confidence by aligning your actions with a disciplined process. Recovery is not achieved through activity. It is achieved through precision, and precision begins with trade selection. Another layer to trade selection is time horizon. Not all trades operate on the same time frame. Some are short-term, driven by immediate catalysts or technical patterns. Others are longer-term, based on macro trends or structural imbalances. These different time horizons require different selection criteria. Short-term trades may prioritize timing, liquidity, and technical clarity. Long-term trades may prioritize macro alignment, positioning, and broader risk dynamics. The key is not to mix these frameworks. One of the most common mistakes traders make is applying short-term thinking to long-term trades and vice versa. They enter a trade with a macro thesis, then exit prematurely due to short-term volatility, or they take a short-term trade and hold it too long, hoping it evolves into something else. Trade selection must therefore include clarity on time horizon from the outset. You need to know why you are in the trade, what conditions validate it, and what conditions invalidate it within the context of that time frame. Without this clarity, decision-making becomes inconsistent. Let's explore the concept of asymmetry in greater depth. Asymmetry refers to the relationship between potential reward and potential risk. A trade with strong asymmetry offers a favorable payoff relative to the risk taken. This is a cornerstone of professional trade selection. However, asymmetry is often misunderstood. It is not just about having a large target relative to a stop. It is about the probability weighted outcome. A trade with a 5-to-1 reward to risk ratio may appear attractive, but if the probability of reaching that target is extremely low, the expected value may not be favorable. Conversely, a trade with a 2-to-1 ratio but high probability may offer better expected value. Trade selection must therefore consider both payoff and probability. The goal is not to maximize either individually, but to optimize the combination of the two. This requires a nuanced understanding of market behavior, it requires experience, and it requires constant evaluation of how different setups perform over time. Now let's bring in the role of information. Markets are driven by information flow, economic data, central bank communication, geopolitical developments, and shifts in sentiment all influence price. But not all information is equally valuable. Trade selection involves filtering information in the same way you filter trades. You must identify which information is relevant, which is noise, and how it impacts your existing framework. This is particularly important in a world of constant information overload. Retail traders often react to every piece of news. Professionals contextualize information within a broader framework. They ask, does this information change the underlying thesis? Does it alter the probability distribution of outcomes? Or is it simply short-term noise? Only when information materially impacts the trade thesis should it influence decision-making, otherwise it should be ignored. This discipline in information filtering directly improves trade selection. Let's address the psychological challenge of missing out. Fear of missing out is one of the primary drivers of poor trade selection. You see the market move without you. You feel that you should have been involved. You enter late, often at suboptimal levels, driven by emotion rather than analysis. This is not a selection process, it is a reaction. The reality is that missing trades is part of trading. You will never capture every opportunity. Attempting to do so leads to overextension and poor decision making. Professional traders accept this. They understand that their edge does not come from participation in every move. It comes from participation in the right moves. Missing a trade that does not meet your criteria is not a mistake. It is discipline. Missing a trade that does meet your criteria requires review. But even then, the focus should be on process, not outcome. The goal is not to eliminate missed opportunities. The goal is to ensure that every trade you take meets your defined standard. Another important concept is trade sequencing. Trades do not exist in isolation. They occur in sequences influenced by previous outcomes and evolving market conditions. After a series of losses, traders often become more aggressive, attempting to recover. After a series of wins, they may become overconfident and loosen their criteria. Both responses are problematic. Trade selection must remain consistent, regardless of recent performance. Each trade should be evaluated independently based on its own merits, not influenced by prior outcomes. This is what we mean by outcome independence. If your selection process changes based on recent results, you are no longer operating with a stable framework. Consistency in trade selection is what allows the law of large numbers to work in your favor. Without consistency, your edge cannot materialize over time. Finally, let's integrate everything into a coherent decision-making loop. The process begins with scanning the market for potential opportunities. These opportunities are then filtered through your selection criteria: quality, clarity, alignment, asymmetry, and execution conditions. From there, you rank the remaining trades based on expected value and portfolio fit. Only the highest ranked trades receive capital, with position sizes determined by conviction and risk parameters. Once in the trade, you manage it according to predefined rules, not reactive impulses. After the trade is complete, you review the decision, not just the outcome, but the quality of the selection process. Did the trade meet your criteria? Was the allocation appropriate? Were there better opportunities that were ignored? This feedback loop is what drives continuous improvement. Trade selection is not a static skill. It evolves with experience, data, and reflection. But the foundation remains the same. You are not paid for activity. You are paid for making high-quality decisions under uncertainty. And those decisions begin long before you enter a trade. At this stage, trade selection should no longer feel like a loose concept. It should feel like a structured discipline that governs how you interact with the market. So we take it one level deeper and focus on refinement, because the difference between a competent trader and a consistently high-performing one lies in how precisely they execute this discipline. Refinement begins with recognizing that not all edges are stable. Market conditions evolve. What worked 6 months ago may no longer work today. Trade selection must therefore incorporate a feedback mechanism that continuously evaluates whether your criteria are still valid. This is where most traders fall short. They build a process, but they do not update it. They continue selecting trades based on outdated assumptions, unaware that the underlying environment has shifted. A professional approach requires periodic recalibration. You need to review your trades not just for execution errors, but for selection validity. Are the types of trades you are choosing still producing favorable outcomes? Has the behavior of those setups changed? Are certain environments degrading your edge? This is not about constant change. It is about controlled adaptation. Trade selection is a living framework. It must evolve in response to changing conditions, but it must do so deliberately, not reactively. Let's introduce the concept of trade journaling from a selection perspective. Most traders journal outcomes. They record whether a trade was a win or a loss. This is useful, but it is incomplete. You need to journal the selection process itself. For every trade, you should be able to answer a set of questions. Why was this trade selected? What criteria did it meet? Where did it rank relative to other opportunities at the time? What was the expected value? How did it fit within the portfolio? This creates a record of decision quality. Over time, patterns begin to emerge. You may find that your highest performing trades consistently meet certain criteria. You may also find that your worst trades share common characteristics, perhaps taken during low trade density environments or without full alignment. This insight is invaluable because now you are no longer relying on intuition. You are using data to refine your selection process. Professional traders treat their decision making like a data set. They analyze it, identify patterns, and make adjustments. This is how trade selection becomes sharper over time. Now consider the role of patience as a strategic asset. Patience is often framed as a psychological trait, but in trading it is a structural advantage. If you have the ability to wait for high quality opportunities while others are forced to act, you gain an edge. Most market participants are constrained. They may have mandates, targets, or psychological pressures that force them to trade. This creates inefficiencies. As an independent trader, you have flexibility. You can choose when to engage and when to step aside. This flexibility is powerful, but only if you use it correctly. Patience allows you to avoid low-quality trades. It allows you to allocate capital only when the conditions are optimal. It allows you to maintain clarity while others become reactive. However, patience must be intentional. It is not about waiting aimlessly. It is about waiting with a defined standard in mind. You are not waiting for something to happen. You are waiting for something specific to happen. That specificity is what transforms patience from passivity into strategy. Let's examine how trade selection interacts with risk management at a deeper level. Risk management is often treated as a separate function, but in reality it begins at the point of selection. A poorly selected trade cannot be rescued by good risk management. It may limit the loss, but it cannot create a positive expected outcome. Conversely, a well-selected trade inherently improves your risk profile. Because the probability distribution is more favorable, the likelihood of adverse outcomes is reduced. This means that trade selection is your first line of defense. When you choose high-quality trades, you reduce the frequency of losses, the severity of drawdowns, and the need for reactive adjustments. This does not eliminate risk, it optimizes it, and this is the key distinction. You are not trying to avoid risk, you are trying to deploy it where it is most efficiently compensated. That begins with selection. Another dimension to consider is scalability. As your capital grows, your ability to deploy it efficiently becomes more challenging. Small accounts can operate in less liquid environments and exploit niche opportunities. Larger accounts require deeper liquidity and more scalable setups. This has implications for trade selection. You need to ensure that the trades you select are compatible with your capital base. A setup that works well at small size may not work at larger size due to slippage, market impact, or liquidity constraints. Professional traders are always aware of this. They do not just ask, is this a good trade? They ask, can this trade absorb the capital I intend to allocate without degrading the execution? This consideration becomes increasingly important as you scale. Trade selection must therefore evolve alongside your capital. Let's talk about decision fatigue. Every decision you make consumes cognitive resources. The more trades you consider, the more decisions you process, the greater the risk of fatigue. Fatigue leads to shortcuts. It leads to reduced discipline. It leads to inconsistent application of your selection criteria. This is why simplicity and structure are essential. Your trade selection framework should reduce decision load, not increase it. By defining clear criteria and thresholds, you eliminate unnecessary choices. You create a process where decisions are largely predetermined by your framework. This preserves mental energy. Professional traders are highly aware of their cognitive limits. They structure their process to operate within those limits. Trade selection is not just about identifying opportunities. It is about doing so in a way that maintains consistency over time. Now consider the role of conviction under uncertainty. No matter how refined your selection process becomes, uncertainty never disappears. You will never have complete information. You will never eliminate risk. There will always be unknowns. Conviction, therefore, is not about certainty. It is about acting despite uncertainty based on structured reasoning. Trade selection gives you the foundation for this. When a trade meets your criteria, when it ranks highly within your framework, when it aligns with your portfolio, you act, not because you are certain, but because the decision is justified. This is a critical shift. You are not seeking reassurance from the market. You are relying on your process. And this is what allows you to operate consistently in an environment that is inherently unpredictable. Let's address the idea of missed opportunity from a portfolio perspective. Earlier, we discussed fear of missing out at an individual trade level. Now we expand that to the broader portfolio. There will be times when a trade performs well without you. That is inevitable. The question is not, did I miss this trade? The question is, was my capital deployed in a better opportunity at the time? If the answer is yes, then there is no issue. Professional traders evaluate performance in relative terms. They measure how effectively capital was allocated, not whether every possible trade was captured. This perspective removes emotional noise. It allows you to focus on the efficiency of your decisions rather than the randomness of outcomes. Trade selection is about optimization, not perfection. You are not trying to capture everything. You are trying to capture what matters most. Finally, let's bring everything together into a single principle. Trade selection is the gatekeeper of your trading system. Everything that follows, position sizing, execution, trade management, depends on the quality of what passes through that gate. If low quality trades enter the system, no amount of discipline later can fully compensate. If high quality trades are selected consistently, the rest of the process becomes significantly more effective. This is why trade selection deserves as much focus as any other aspect of trading. It is not a preliminary step, it is a core function, and it is one of the few areas where you have complete control. You cannot control the market, you cannot control outcomes, but you can control which trades you choose to engage with. That control is where your edge begins. As you move forward, the objective is to internalize trade selection as a default mode of thinking. Every time you look at the market, you should be asking, does this meet my criteria? Where does this sit relative to other opportunities? Is this the best use of capital right now? This questioning becomes automatic with practice. Over time, you will find that your tolerance for low quality trades decreases, your patience increases, your decision making becomes more deliberate, and importantly, your performance becomes more stable. Because you are no longer relying on random outcomes, you are relying on structured decision making. Trade selection is not about being right, it is about being selective. And in a profession where most participants are driven by impulse, Selectivity is a powerful advantage. Master this and you fundamentally change how you interact with the market. You move from reacting to opportunities to defining them, and that is the transition from participant to professional.